Happy Monday. I hope you had a great weekend. The heat is on, that's for sure. The Earth just reported the hottest week on record, until maybe this week. Also, just to be balanced, let's see what the winter brings for extremes. Nonetheless, the markets were on fire themselves last week. Let's recap last week's action and preview this coming week. There's a lot to cover. Last week was a full 5 days again, and this week earnings keep rolling on. Last Monday started with a bit of an upside bias. Used car prices dropped sharply, still elevated from pre-pandemic. Some say they'll never get back there again, but they were down this time. And again, New York Fed consumer inflation expectations dropped also. Immaculate deflation is the term being used, and these eco data points supported that. Fed head Bostic tried to put some cold water on the move, but the markets held their own. The Dow was up almost 2/3 of 1%, the S&P up about 1/4 of 1%, and the Nasdaq up slightly. The move higher kept going on Tuesday as eco data from overseas kept things moving. German CPI and Chinese stimulus. The Dow was up almost 1%, S&P up about 2/3 of 1%, and the Nasdaq was up about 1/2 of 1%. It did look to me like the algos took over as the melt-up happened at the end of the day, prepping for the CPI number on Wednesday, and Wednesday did not disappoint. CPI report was cooler than even expected, and treasuries ripped higher, yields falling, and the dollar dropped. Disinflation was the word of the day, and all the bets were back for one and a pause for the Fed. They seem to be going back on. I don't have any argument that this was a great report, probably the best news in a while, but I will say that in my opinion, the market is already pricing most of this news in. We've been talking about this for a while. Spoiler alert, as earnings started last week and more this week, eyes will turn to valuations. As I've been telling you, this CPI and Thursday's PPI, more on that in a moment, they do support some sort of soft or softer landing scenario. But as we keep seeing and hearing, this has to play out and be supported by more numbers. Fed heads Barkin and Kashkari were on the tape reiterating that inflation is still too high. Nothing new there either. Markets rallied on the news and moved technically as well. Dow closed off of its morning high of up 300, but it closed up 1/4 of 1%. S&P closed at a new year-to-date high, up a bit over 3/4 of 1%, and the Nasdaq closed up almost 1.25%. A nice setup for a good PPI. And that's what we got on Thursday. For the third day in a row, stocks gapped to open higher, this time on the back of cool PPI numbers. On the negative side, ignored. Jobless claims hit a new multi-week low. Good for the employees, but not for the Fed. And as I said, this was ignored, and the focus was on the best of all worlds, as some like to see it. CPI and PPI showed slowing inflation. Quick reminder that nearly everyone at the Fed still says inflation is too high, but slowing by these numbers. Also, a help was Delta Airlines and PepsiCo earnings. They did great. One reason, pricing power. Let's take note of that, by the way. Remember inflation? Yes, airplane tickets and snacks, those prices and the growth in those gains, we'll have to see what that is. It's not slowing. 70% of the inflation move was also still from shelter, but obviously there were offsets enough to keep the rate of change slowing. And that rate, by the way, is year over year versus last year. Remember that we're over a year into the inflation watch, so the year over years don't look quite so bad. Overall, the Dow was up slightly. The S&P closing for the first time, over 4,500 for the first time since early 2022, up over 3/4 of 1%, and the Nasdaq was up over 1.5%. On Friday, stocks continued higher from the start. Eco data from Europe kept the support up from the eco side, and for the earnings side, the banks did not disappoint with the numbers. J.P. Morgan, Wells Fargo, and Citi all topped estimates. Consumer sentiment, as you would expect, and you probably feel it yourself, was high again. But inflation expectations also jumped, and as I have been mentioning, this market is a bit on edge and overextended. So as I tell you a lot, I think you'll see a lot more volatility in the second half of the year. Regardless, after opening strong, the bulls could not hold all their gains across the board. For the day, the Dow held on with the strong earnings from some Dow stocks. Dow was up over about 1/3 of 1%. The Nasdaq and the S&P were both down slightly on the day. For the week, though, the Dow was up 2.25%, S&P up almost 2.5%, and the Nasdaq was up 3.33%. That put a wrap on last week, but the rear view is important. But let's gaze out the windshield for this coming week. There's some eco numbers and a few Fed speakers, and I do think that will move some markets. Retail sales tomorrow, jobless claims on Thursday should be the big numbers. In keeping with that, a quick note to sum up why the markets seem to be moving up and what it might take to have them move up more. Falling inflation and stable growth is that soft landing that we're looking for, and last week's data supported that. Good earnings for the growth side and falling inflations for the eco side. While I am an optimist, I also try to stay firmly rooted in reality. There are still storm clouds that can erupt, but let's recap a bit of my take on the situation. First, valuation. We're pretty close to price for perfection, and that may be good. Progress, not perfection, is what I prefer, and we are definitely making progress. There are tailwinds brewing. The falling dollar, inflation falling, growth stable, labor market stable, but there are also the concerns about headwinds. More rate hikes, holding them for longer, margin pressures, thus earning pressures, so much on both sides. We also still have the inverted yield curve to worry about. Also, that being said, I remain in the camp that says that this will turn to earnings to see the next leg will be driven by, to see where the next leg will go. It will be driven by two things, in my opinion. One will be the treasury markets and yields that fall pretty sharply. On top of that, we'll need to have a pretty good second half of the earnings on the earnings side. This quarter's reports just started, and the estimates are for a 7% decline year over year. LPL Research thinks that, like last quarter, it will be negative year over year, but not the 7% we see now. So we'll see how that goes. For now, remember, this week, watch the earnings and watch retail sales and jobless numbers, and as the market seems to react to strange things, expect the unexpected. I'll be back Friday with some more planning ideas on how to stay focused on the long-term goals, yet still incorporate this market news into the plan. Until then, stay in touch and have a great week.